Is high interest rate affecting your quality of life? Wait, we can help. Young and Rich University. Have direct access to the best mortgage brokers in the Greater Toronto Area that can better serve you, lowering you interest rate and monthly payment, so you can live the life you truly desire. Call or text 647-237-3642.
Here we go, folks. YRU. YRU, Young and Rich. This is Young and Rich University. The question is, why are you not rich? Or why are you rich? What did you do in the past? What you currently doing to better your financial future? We are wealthy parents raising wealthy children. And it all starts with the right form of education. Not the formal one. We're talking about financial education. Well, today I have an amazing guest. He's a seasoned mortgage agent for over 14 years in the industry, specializing in wealth building strategies. He's a certified expert in the Smith maneuver strategy and been helping clients paying off their mortgages for more over 10 years plus. No other than Charles Ayodele. Not only is a mortgage agent, he's an investor as well, commanding over $8 million plus in real estate assets, and his portfolio is growing. Ladies and gentlemen, you can ask all the questions you want. He's credible. He's done the work. He has history. Some might call him a veteran in the business. He's been around for so long. I have personally worked with him over the years, and we have maximized the potential of a program called a PPI, which is a Purchase Plus Improvement Mortgage. Not only do the banks give you a mortgage, they help you to renovate it as well. And we hammer on that mortgage process over the years past. It might still be relevant today, but you have to talk to Charles about that on a one-on-one base. Ladies and gentlemen, welcome no other than my guest, Charles Ayodele. Charles, how's it going?
I'm doing great, Frank. Thanks for having me.
Thank you for being on our podcast. Well, you know, we've created this podcast called YRU, Young and Rich University. And we ask everyone that come on board is, why are you rich or why are you not rich? And I'll start off with you right from the jump start. Why are you rich?
I work hard, I invest, and I make sure I get in contact with the right people. When I first started in this business, I was fortunate enough to come to one of your courses and learn a lot of good things that I was able to help me start building my foundation to wealth.
Excellent, excellent. And then you moved past that, you became a mortgage agent.
Yes.
Right. And we started working together. Charles was new in the business.
Yes.
He was new in the business, and we started working together. I used to call him day and night, 2 o'clock, 3 o'clock in the morning. And I said, I need a product that can benefit my investors. We predominantly work with investors, people building wealth. And we would be in the phone 2, 3 o'clock in the morning, and we hammering out strategies.
Yes,
and then
exactly.
up come the PPI. Tell them what the PPI is about.
The Purchase Plus Improvements. The Purchase Plus Improvement was, it's still around, by the way, but the program was designed for people who were looking to purchase a property right away, but they didn't want to wait a year or 2 years for a new construction property. So it gave them an opportunity to buy something that was ready to go, and then they can update it by painting, doing some cosmetic stuff, painting, changing the kitchens, maybe even changing the washrooms as well. Now, the cool thing about that Purchase Plus Improvements, the way it was set up was you could go to one contractor and he give you a high quote and say, hey, it's going to cost you X amount of dollars, right? All they cared about, the lender cared about, was that the work was being done. So then you can turn around and say, hey, I can go to another contractor, or you can also do it yourself, because it's very popular that people start doing it themselves. People say, hey, I can pick up a paintbrush, right? That's not a big deal. And so by doing it yourselves, all the lender cared about was that you completed the work.
Right.
So once the work was complete, you were already approved for that large amount of quote. So you're able to get extra money, and that extra money you can now use. And that's what a lot of investors were using to be able to not only purchase one, sometimes two or even three properties with us.
Excellent. Because not only when they did the renovation, what the renovation did was increase the equity in the property.
It
They got,
100% did.
they got instant equity. So within a year or so, Charles could have refinanced your mortgage, get you some cash out as well to move on to the second and third property. And we did
That's
very well with
exactly correct.
that project. But we on to big things.
One of the cool things. Sorry,
Go ahead, Charles.
I was going to say one of the cool things, like you just said, was because we focused on kitchens and bathrooms. That's where the value was in houses.
Right, absolutely. And the equity increase immediately or in a short time frame, and you can appraise the property at a higher market value, and you take it from there. And we did very well with our project. We help people who had little money; they just have barely 5% down or 10% down to buy their first home, and they bought their home and they renovated the property, and they could have moved on to something as a year or two later on. And we help a lot of families in the GTA in acquiring assets and in true real estate. So Charles is somebody I've been working with for plus. If Charles been in the business 14 years, I've been working with Charles for 14 years.
Yeah, that's about right. That's about right. And yeah, you're right. We helped a lot of families. We created a lot of millionaires using that program.
Absolutely, absolutely. Lots of millionaires do that.
Yeah.
So thank you very much. Congrats to your years of service. You survive. A lot of people, I work with a lot of mortgage brokers over the years, and not too many of them still around. So,
It's a tough business. It's changed over the last couple of years for sure.
yeah. So you survive many ups and downs. You survive many financial crises. You survive many interest rate hike. You survive COVID. You survive all those ups and downs in the marketplace. Well, how are you able to do that? Whereas some people were suffering and having a tough time during these financial instability in our economy.
Great question. I felt that I was always an investor first. I always thought as an investor first. One of the main reasons why I got into the business is because I wanted to build my portfolio. I wanted to grow my portfolio. So I was always thinking with that, with the hat on like that. It's what attracted me to come to your courses. It's the reason why we work so well together is because we both think as investors and how to be able to grow. So from that standpoint, it allowed me to be able to stay in this business and think 5 or 6 steps ahead.
Excellent. That's a good answer. And Charles is absolutely right. When I get involved in the real estate business, just like Charles, we had the same vision. I put investment first. And this is what I know about investors. Investors buy not only one, they buy 2 and 3 properties if the deal is right. They can get
That's
financing,
correct.
they buy 2 and 3 properties. And in a dung economy, when everybody's running scared because either government hike interest rates or because there's COVID or because the financial meltdown in the United States, when everybody runs away, investors come to the table and says, Charles, if you can get me a mortgage, I see a property selling for half price, I'm going to buy it.
Exactly.
So if Charles is servicing the investment community, he's always going to be busy. So I've created myself, and Charles did the same thing. We create a recessionary proof business model. So when people are running scared, we are still sitting there to answer that phone and say, listen, we can help you. You don't have to run scared. Come over here. We can get you refinanced. We can drop the interest rate. We can get this, do that. We can do that. Do that. We have different programs that comes out to help the person change their financial situation. So that's very smart, Charles, for sticking to that program and being a part of the industry and servicing our community the right way. And Charles also educates his clients and on different steps to take when they have different problems going on in their life. But we onto something different now. Charles is doing something not different, but he added something to his portfolio. Charles, what the heck is a Smith maneuver?
I'm glad you brought that up. And again, when I first heard of it, I was 100% attracted to it because it follows the vision of the reason why I'm in this business. Right? It's for investors. It's about saving money. It's about building wealth, and it's about creating legacy. Right? This Smith maneuver has been around since the early 80s, and I was surprised that I only heard of it a few years ago. But essentially, what the Smith maneuver is about a lot of people know when you buy your owner occupied property, you cannot write off the interest of that mortgage. You just can't do it.
That's correct.
Right now, there was a couple of things that, Frank, you taught in your course that you were saying, hey, you can rent out your basement and part of your house could be rented that way. You can also set up a piece of your house to be an office and you can get that. But with the Smith maneuver, you can do the 100% of it and you can transfer your interest from being non-tax deductible to tax deductible. And
Slow
that's what
down.
the Smith maneuver
Slow
is
down. You're
about.
slow down. You're going too fast. Let's go through this again now. You go through that again for me, please. Thank you. You're going too fast, bro. It sounds interesting, but you're going too fast. Go ahead again.
Okay.
Let me hear you. Yeah.
So, okay, I'll be slow. I'll be slow. So basically, the interest on your owner occupied, the house that you live in,
Mm-hmm. Yeah.
right? You cannot write off the interest right now. You can't do it, right? You go
Right.
to your tax, and this is why we were buying investment properties. You can buy investment properties and you can write the interest off of everything in the investment property, but you can't do it on your owner occupied. The
That's
Smith
correct.
maneuver has a maneuver of a way for you to be able to start writing off the interest on your owner occupied property against your income.
So how do I do this now?
Great question. So it's set up in a way that you first want to get a particular product that is readvanceable. That's
Mhm.
simple terms. You need a mortgage and a line of credit. So you need to
Right.
be able to be when you're making your mortgage payments, your line of credit grows. Once you're able to do that, you're now able to take the principal amount because the principal amount is what's growing in your line of credit. You're now able to take that and you're now able to invest it in any vehicle that you choose to do. And once you invest it, right, the interest from the line of credit is now tax deductible. You are actually transferring your mortgage from being non-tax deductible to tax deductible.
All right. So I like that. So I'm gonna go through it again and tell me if I'm because I want to make sure they get this right. So Charles is saying you having I won't call it a hybrid. We have a two-stage mortgage product. You have a mortgage and you have a line of credit. So when you pay
Correct.
your mortgage every month, the principal that you normally pay that's paying down, that normally pays down the principal, goes on to that line of credit. Now you can take that money from that line of credit and invest in anything you want. Maybe another property, maybe another business, maybe whatever you want, in mutual funds, stocks, whatever you want. And 100% of that borrowed money is tax deductible.
That's correct.
That's an amazing product. It's an
That's
amazing
correct.
product. You see that,
That's
folks?
correct.
That's why we call him Charles. We used to tease him and call him the godfather of the industry. He always have these unique strategies that just make sense from an investment perspective. Okay, just like the PPI, this makes sense. Okay, so Charles says this product been going to go wrong since the 80s plus. Why are we now hearing about it?
It's interesting. Remember, it came out in the 80s when interest rates were very high, double digit interest rates. So it made sense back then. The
Right.
reason why we haven't heard of it recently, it's because in the past 10, 15 years, it's been low interest rates. So there was really no need for it. Now that we're having higher interest rates, we have to look at different ways of investing. We have to be able to keep ahead of inflation.
Mm-hmm.
And the Smith maneuver is a great path of doing that. So that's why you're now hearing more of it in the last couple of years because interest rates are now coming back. And that's why you haven't heard of it.
Well, here's the thing. Most people want to go home, go to work, get their money, pay their mortgage, and pay it off to zero. Now you're saying go create debt. Why would they want to do that?
Great question. So it's funny, right? There's something called bad debt and good debt, right? Now, bad debt is you have something, you're paying it down, and it's depreciating. There's nothing you can do with it, right? We as investors want to be able to use our money to grow money. That's what we want to do. And
Right.
that's what we consider is good debt. So we want to have our money actually working for us. And that's essentially what we're trying to do here with the Smith maneuver. So essentially, once you're paying down your mortgage, you're still pulling it out and it's still working to your benefit. And the way it's working to your benefit is by helping you get some of your tax dollars back from the CRA.
Oh, so hold on a second now. Not only am I able to invest that money back again, I get more money back from the government?
That's correct.
I like it.
That's correct.
So you invest, you pay your regular mortgage, folks. You build the line of credit by adding the principal to the line of credit. You take that money out, you invest in a second or third property, and you get a tax deduction for doing that. For spending your own money, you get a tax deduction from the government. Now, some folks might say, Charles, this sounds too good to be true. What do you have to say about that?
It's been around since the 1980s, right? And the rich have been using it. They've been using it. It's not like something that just came out a few years ago. It's not too good to be true. This is something, if you do it correctly, can be worthwhile to you. Right? Now, I'll also say this. It's important. It's important. And a lot of people mess this up. It's important that that money is used for investments. If you use it for anything else that's not investments, if you decide to go on a vacation, if you decide to buy a new car, then it's not tax deductible. You cannot mix up the two. That's the key thing.
Right. Now, when I hear people say the rich has been doing it, that brings a big red flag for me. Because here's why. When I hear the rich has been doing it, I see the rich do it and they get a free pass. The average guy doing it, he gets a handcuff. So the question is the Smith maneuver a legal strategy by the CRA?
Yes, it actually is a legal strategy by the CRA. I actually have a few people who work at Revenue Canada that have helped with the Smith maneuver, right? It has been tested, right, up and down. And simply the main thing of why the Smith maneuver is legal is because you are using that money to invest. That's what makes it legal. The once you decide not to use it to invest, it changes everything.
Okay, excellent. So I pay my mortgage, I invest the money into a second property or so, or another investment vehicle. What if I lose my job, Charles?
Great question. Well, this particular it's recession proof, right? So the whole point of this is to be preactive, right? You want to be in a situation that if you do lose your job, you're not going to lose your house, and you're not in a situation where you're scrambling when you're ready to find another job. That's why you want to do these things. That's the whole point of the investments that you're setting up. You're not only setting up to make sure that your legacy is set up, but you're also setting it up so your family's is worthwhile as well. That's what you're doing.
Right. So technically, you're saying every investor who have 2, 3 properties or have 2 properties or more looking to get a second and third property, they should be talking to you about the Smith maneuver strategy.
100%. 100%. You want to be in a situation where you can actually make your property tax deductible if you have 1 investment property in less than 15 years. If you have 2, you can have it less than 7 years. And if you have 3, it's less than 4 that you can make your property tax deductible. And you can also be able to pay off your mortgage and your investment property in less than 15 years with those multiple investment properties.
Oh, that's very good. Very good. Very good.
It's a very powerful tool.
Yes, very good. So how does the high interest market affecting your clients right now?
Well, I have a lot of clients in situations where they purchased 5, 6, 7, 8 years ago, and they were paying anywhere between $2,500 to $3,000. And now with the new high interest rates, they're jumping up as high as $1,400, $1,500 a month more. So they're basically everything has gone up, right? So inflation has caught up to them. So they're in situations where it's hard for them to carry this situation. Now, are they going to make do with this? Of course they are. Most people are. They're going to make do. But you don't want this to come around again and catch you a few years from now. You want to be able to put yourself in a situation that if interest rates go up again and inflation, and we're in this particular situation again, because we
Mhm.
all know these things are circular. You
Right.
don't want it to catch you again. So by doing stuff like this, you put yourself in a recession-proof situation that allows you never to be in this situation, and you're comfortable.
Okay, excellent. And so we have, by announcing that you come in on our show today, we had a few people that send in some questions. So what I'm going to do, Charles, I'm going to play a couple of these questions, and you can answer them and find solutions if there's a solution, or just reinforce what people are thinking already. All right. So here's the
Awesome.
first one. Here's the first one coming up here.
Is high interest rate affecting your quality of life? Wait, we can help. Young and Rich University. Have direct access to the best mortgage brokers in the Greater Toronto Area that can better serve you, lowering you interest rate and monthly payment, so you can live the life you truly desire. Call or text 647-237-3642.
Hi, it's Asina. I had a question for you on mortgages. I was wondering, as a first-time home buyer, how do I decide on what type of mortgage to get? How do I decide between getting the adjustable rate mortgage or the fixed rate mortgage? And what are the pros and cons of getting the adjustable rate mortgage?
You get that?
Great. Yeah, I heard that. Great question for a first time home buyer. First thing, there's three things a first time home buyer needs to consider. They need to consider employment, making sure that they have income to be able to qualify. They need to make sure that their credit is good enough, right? So that they can be able to put as minimum down as a first time home buyer, right? And then they want to also make sure that they have a down payment. Those are the three things. Now, to choose the preference on what type of mortgage, the first thing I would say is it would depend on qualifications. So right now, it's a lot easier to qualify for a fixed rate because your purchasing power is a lot higher with a fixed rate than an adjustable rate mortgage because the adjustable rate mortgage is high right now.
Right.
So, but some people want to take advantage of that adjustable rate mortgage because they know that because it's high, it's going to be able to come down. So you just need to understand that you do have that option, but your purchasing power may be a little bit less when you're out there purchasing. It could be a difference of anywhere between fifty to $60,000 in what you're purchasing, and
That's
that
a
could
big.
be a difference between getting a two bedroom or a one bedroom.
That's a big
So
difference.
once you keep that in mind, you'll know you know which avenue you want to go with.
So right now the fixed rate mortgage is working in your favor, but a few years ago, variable rate would have been the one to choose from.
Yes.
So you have to
Yes, a
adjust.
few years ago it would have made sense. Now you have some people who took that variable rate a few years ago, and because interest rates have gone up, they're now scratching their head saying, "Did I make the right decision?"
Mhm.
Personally, I think you did. Right? You have to look at overall the term of the mortgage, right?
Mhm.
And for the first couple of years, you were paying a low interest rate. So for the next couple of years, if you're paying a high interest rate, if you average it out for that 5 year term, you still win. You still luck out in that term.
Well, you say you still win, but let me explain this to you. Some folks been paying on the variable rate mortgage $1,500 a month. Interest rate increase, and that turned to $3,000 a month. So explain to me how they're still winning with a double monthly payment.
Well, I'm saying this on average. I'm saying that for that they're paying that 1,500 probably for the first 2 or 2.5 years, maybe even 3 years. They're paying that.
Right.
And so for the next 2 years, yes, it's gone up. So on average, they did pay less. Now, if they were investing the extra money that they had, they put themselves in a good place. But if they're just spending it anyhow, they put themselves in a bad place. So
Right.
on average, they're doing better. Now, I'll also say this too. When your interest rate started to go up on the variable rate or the adjustable rate, you saw it coming. So you were able to budget better. The people in a fixed rate mortgage, they're not seeing it coming. They're going straight from paying $1,500 and then all of a sudden they're renewing at $3,000, right?
Right.
They've already set up their budget. They've already bought their new cars. They've already set their vacations. They've already made lifestyle decisions, life changes. And then all of a sudden, bam, they get hit with this new mortgage amount. With the
So
adjustable rate, you saw it coming.
so with adjustable rate, they had a lower interest, which gives them a higher disposable income. And you saying they maximize that on lifestyle stuff.
Exactly.
So
You're
then when
able
they
to make decisions.
so when the interest rate increase now, they end up in financial struggle.
Exactly.
Whereas if they invest the difference of that money, they would have a nice nest egg sitting on to put themselves in a good financial position.
That's
There,
correct.
there you go, folks. Choosing the right mortgage is important. So even though the mortgage program, whether it's fixed rate or variable, give you a low monthly payment, it doesn't mean you should go max out the rest of the money to go and travel and vacation, all this kind of stuff. If you can invest that money in something else, it makes it even better for you because then you're leveraging more and more on your financial abilities. Charles, great answer. I have one more question or a couple more questions. This one is very interesting. Let's hear what she has to say.
Hello, my name is Karen, and I have a question. If you and a group of friends are starting out with a brand new small business and you all wanted to purchase a property together, what is the best way? Should we all get individual loans or should we apply for a huge loan together for like $1 million property?
You understand that?
Interesting question. Interesting question.
Mm.
My suggestion would be to set up a numbered company so that the entity of that numbered company is actually purchasing the property. By doing that, it still allows you to be owner of that property, but the numbered company would own that property, which still allows you to be able to purchase something on your own if later on you want to. If there's a group of you doing it, that would be my suggestion.
So if it's in a numbered company, the numbered company own the property. You're still a partial owner of the property, but your name is free and clear to move on to buy more real estate personally for yourself.
That's
So
correct.
okay,
That's
excellent.
correct.
All right,
That's
good stuff.
correct.
Let's have another question here, and then we can move on. One more question.
Hey there, this is Amber. I'm looking to make my first home purchase and I have two questions. One, do you think the rates will go down anytime soon? And secondly, do you think I need to wait for rates to drop before making my purchase? Thank you.
I get this question all the time. Right now is the time to buy. Don't wait on rates. I'm telling you right now, do not wait on rates, right? Rates are not going to come down as fast as they went up, right? And think about it from this standpoint. Once they actually start to come down, that means housing prices are going to go back up.
Right.
So it's going to be a lot harder to be able to get that place that you're looking for. My suggestion is you buy now. There's a lot of great projects. There's a lot of great deals out there for you to be able to take advantage of right now where interest rates are today. So knowing that the variable rate is high, the fixed rate is actually not as high, right? So you can be able to get something and be affordable and get a really good deal today.
Makes sense. There you go, folks. There's a lot of solutions in the market for first-time home buyers, second-time home buyers, investors. Right now, the market on a price perspective is down compared to a couple of years ago. So if you decide to move on into the marketplace and secure your first or even second or third property, you're getting a good value, a good bang for your buck. Talking about investment properties, what is the ratio you're working with for the loan to value ratio you're working with for investment properties?
When it comes to how many investors I work with compared to first-time home buyers?
No. The question is, how is the qualifying ratio, the debt to income ratio. Has that changed compared to what it was a few years ago? What are lenders looking for?
It is changed. It has changed. They've added the stress test, which is a big deal. They've also, and because they've added the stress test, you have to now qualify at a higher rate to be able to purchase that property and qualify for the lower rate. That's a big one.
And what are any particular strategy you're using to help the investors, especially guys who buy multiple properties, to help them qualify?
There's a couple things. Because it's an investment property, you have to have 20% down. So there's a little bit of leeway in terms of qualifying when you have 20% down. How they actually qualify the deal in terms of the rental offset and also extended ratios is also given by a lot of different lenders. So they're able to work a little bit more with you when it comes to investment properties or properties that are 80% loan to value or less.
Excellent. And I'm pretty sure you hear this question all the time. Mortgage brokers fees and fees and fees and fees. What is a person supposed to look out for? How do we avoid that, or they get rid of that, or they minimize it? Sometimes you can't get rid of it; you just have to minimize it. How do you deal with that? How do the average consumer deal with that? The fees that the mortgage broker is charging out there.
Okay, majority of my deals, I don't charge any fees. Majority of my deals, right, are with A banks, and the A banks pay me a referral fee for bringing that file to them. There's only some times where I have to take those deals to an alternative lender like a trust bank or a credit union or even a private to be able to get that deal done. And from that standpoint, I have to charge a fee because the lender is not paying me a referral fee with those lenders. Now, the reasons why I would go to those places is for a couple reasons. One being it's hard to prove the income for self-employed individuals. And sometimes with bruised credit, A banks only want cream of the crop people when it comes to their credit. So sometimes you're being put in a situation where you have to go with an alternative lender. Now, I let clients know this up front, far in advance, so that they can make the decision and also be able to put it in their budget to make sure that they understand how much it's going to cost to be able to purchase that property. I also let them know that by buying this investment, honestly, by paying for the mortgage broker fees, the lawyer's fees, the land transfer tax, it's a small fee to pay on what you're actually going to be making by owning that property.
Excellent. Yes, absolutely. Absolutely. So there you go, folks. For those who learn about fees and fees and fees, what Charles and many other professionals are saying in the industry, your fee that you're paying is small compared to interest rate dropping 0.75%. You just got a $50,000 appreciation in your property. Interest drop 1-2%, you got $200,000 appreciation in your property. Why are you concerned about fees? The concern should be, can you qualify? Can you even get into the market? Can you even own that vehicle that can appreciate well for you? And that's what almost all these professionals are saying. Don't worry about the cost to get in. Just worry about getting in. The cost going to work itself off over time. And if it's an investment property, can they still write off the fees as a tax break, Charles?
Yes, absolutely. They can write it off as a tax break. I tell my clients that all the time. All the fees that you pay in your investment property is all tax write-offs.
Excellent. And where you see the mortgage or real estate market trending for the next 5 to 10 years? Your prediction?
So I see that interest rates will go down a little bit. They may go down maybe about 1% in the next year, right? Which will probably bring the market up a little bit, maybe about 15-20% higher. But there's still a shortage of housing. So there's always going to be a demand for the next 5 to 10 years. So my suggestion is people buy your investment properties now because there's going to be a shortage. There's going to be an excess of people who need places to live. And because there's a shortage and interest rates are high, there's going to be an excess of people who cannot qualify and need a place to live. So you guys want to be able to get into the market, buy that investment property, right? And be able to start making money now. Trust me, by doing some of the strategies that we talked about today, you can be able to turn around that property within the next 10 years.
Very good. Very good. And folks who's interested in getting access to you and contacting you, Charles, how can they contact you?
Oh, thanks. So you can contact me by email at mortgages@financesbycharles.com. You can also hit me up on Instagram at financesbycharles.com as well. My website is financesbycharles.com. You can also Google me. My name is Charles Ayodele. I do a lot of promoting out there, so you can always Google me as well. If you also want to book a time to have a discussion, you can just type in chatwithcharles.ca. That's very simple. Chatwithcharles.ca.
Yeah, that's pretty good. Yeah. So, any final advice or direction for our listeners?
Yeah, like I said, it's a great time to buy. Get out there, right? Start looking for stuff. Speak to professionals like myself or Frank, and be able to get out there and get your investment properties going.
Excellent. Thank you very much, Charles. Thank you very much for being on our show. And we look forward to having you again on sometime in the future. To your success.
Thanks, Frank. Thank you. All right.
Yes, folks, there you go. That's the reason why we call him the godfather of the industry. YRU. Young and Rich. This is the guy that mastered the PPI program, the Purchase Plus Improvement program. Now he's on to the Smith Maneuver, working one-on-one with investors, trying to help you change your financial direction. He works with first generation, second generation real estate investors, and not only get you your mortgage, he's investing himself. So exactly what you want to do, he's doing already. Over 15 plus years in the business, helping real estate investors change their financial portfolio. Again, my name is Frank Corbin. I'm the host for the Young and Rich University, Young and Rich podcast. To your success, we just shoot another one. See you then.